Taxation is an instrument used by the government to achieve its social and economic objectives. It is the price paid to enjoy the benefits of law and order, protection against external aggression, and access to essential services like electricity, water, transport, healthcare, education, and sewage disposal. Taxes can be grouped into two categories. Direct taxes. These taxes are paid directly to the government on income and wealth. They can also be deducted at the source of the income. Indirect taxes. These taxes are charged by the government indirectly by charging taxes on the goods and services consumed. The common indirect taxes in India are value-added tax, service tax, and excise and customs. The goods and service tax bill, when implemented, will combine all indirect taxes into a single piece of legislation in an effort to standardize and simplify the tax code. We'll be discussing direct taxes as they require planning and reporting. Indirect taxes, on the other hand, cannot be planned for. Wealth tax. Wealth tax is intended as a tool to tax the rich specifically. It has been discontinued in India but might be brought back by future governments. Income tax. Income tax is the government's primary source of revenue. As its name suggests, it is a tax on income earned. Random Walk Ed will take a look at income tax for individuals. In the case of organizations, consulting a chartered accountant might be necessary. To understand direct taxes in India, we must first understand two major concepts. First, the difference between the assessment year and the financial year. The one-year period between 1st of April and 31st of March is known as the financial year. The financial year is the period in which income is earned and taxes are paid. The assessment year is the year following the financial year. The assessment year is the period in which tax returns are filed and assessed, and it is also the period in which income tax refunds are paid out by the government. Second is the definition for a resident. Residential status determines the tax payable by a person. There are three types of residential statuses. Resident. All income of a resident Indian is taxable in India. A resident is determined by the following conditions. If the person is in India for a period of 182 days or more in a financial year, or if the person is in India for 60 days or more during that financial year and has been in India for 365 days or more during 4 previous years immediately preceding the relevant financial year. Non-ordinary resident. Indian income and foreign income from a business controlled in India is taxable for a non-ordinary resident. A non-ordinary resident is determined by the following conditions. If the person has been a non-resident in 9 out of 10 years immediately preceding the financial year, or if the person has been in India for a period of 729 days or less in 7 previous years immediately preceding the financial year. Non-resident. A non-resident is a person who does not fall into the definition of a resident or a non-ordinary resident. The Indian income of a non-resident is taxable in India. Our next episode will give you an overview of the Indian income tax regulations. Random Walk Ed is created by Random Walk Investment and Financial Services. You could contact us if you need assistance with your finances or are looking to make investments. Please contact us by email in case of queries. Please consider supporting Random Walk Ed on Patreon. Your contributions will help us improve our content and continue making it available for free. Subscribe to our channel to receive updates on our latest videos. Share this video with anyone who might find it useful.